Hello, everyone. Welcome to this episode of Trading Macro, short video where we'll actually explore the 5 different steps you need to go through in order to sort of successfully trade macro headlines. Okay, and here's the immediate trigger for today. It's a Trump tweet. Now, what are the 5 steps you need to do in order to trade a macro headline? You need to understand the context and background. You need to understand the various possibilities of a particular event, the various scenarios. Number 3, you need to understand a specific catalyst or trigger. Number 4, you need to understand how the different asset classes, commodities, bonds, equities, FX, for example, how those instruments and asset classes will actually react to different scenarios. And number 5, you need to understand the correct expression of that trade idea. Should it be with sort of ETFs? Should it be with options, with futures, this kind of thing? Okay, so first of all, let's look at the context here. The context is that the Federal Reserve is looking for a new Fed chair. Chair Powell will be replaced probably in May sometime. What the market wants is someone who's an independent expert, someone who will set monetary policy in the appropriate way, the way which is appropriate to the state of the US economy. What the market does not want is a puppet who will simply do Trump's bidding and may actually cut interest rates too strongly and too much in an unwarranted and unjustified way, which would actually cause a lack of sort of trust in the Federal Reserve, which is a big problem, and B, could potentially reignite ignition with an overly sort of accommodative or an overly loose monetary policy. Now, so what are the various so that's the general sort of context and background. The different scenarios in this case, number 2, is that we have someone like Kevin Hassett, who's considered a Trump yes man. He's a director of the National Economic Council and is very, very close to Trump and is considered a loyalist, not very independent. There are other candidates like Kevin Warsh and Chris Waller who do have Fed experience and who are considered, relatively or more independent than Kevin Hassett is. So there's the different sort of scenarios. Now, let's go on to the trigger here. Trump basically came out and said at 10:20 with a tweet that the NEC director, Kevin Hassett, the Trump loyalist, was good on television at explaining the White House priorities and economic policies, and therefore Trump thought he wanted to keep him where he is. What is the conclusion? What is the trigger here? The market is suddenly saying, at 10:20, this is interesting. Maybe we are not going to get the Trump puppet, the Trump loyalist. We will get someone who's potentially more qualified, more independent. So it could be Chris Waller, but even more probably someone like Kevin Warsh. So what does that mean? That means that the market suddenly has to readjust to potentially a less dovish Fed, a more hawkish Fed, a Fed which is maybe cutting interest rates less, so interest rates would not go down as much. But on the other hand, a Fed which has more credibility, more independence with global markets, stronger for the US dollar, more trust in the US dollar, in general in US sort of economic governance, and also would be fighting inflation in a stronger way. So therefore, we need to look at the different instruments and how they all reacted, and they reacted in a very sort of a classical way. Probably the thing which is the most important is to understand the bond market immediately. So let's have a quick look at the front end of the bond market in the form of the ZT, so the 2-year bond futures. As you can see, when the tweet came out at around about 10:18, 10:19, 10:20, something like that, the bond market, the front end of the bonds sold off very aggressively. Why is that? Because the bond market, the front end bonds, the ZT, prefers a looser accommodative policy. That's what the Fed controls, is the front end of the curve. So the fact that there potentially could be a more sort of hawkish leader of the Fed is actually a negative for the front end bonds. So they sold off. Secondly, long-term bonds, let's take the ZB here. We'll put it on the daily chart, so the 3-minute chart. That also sold off. Now, why did that sell off? Because, bonds in general, the 2-year or the 30-year, they prefer lower interest rates and a more accommodative Fed than a more hawkish Fed in general. But what we'll notice here is that relatively quickly, after 6, 7, 8, 9, 10 minutes, there was actually a bit of a recovery in the long end of the bonds. And this actually caused what we call sort of a flattening of the curve. So if we actually look at this here, we can see that the curve flattened a little bit. And you can see here, this is the spread between the 2-year and the 30-year yield. So that's the 30-year yield, subtract the 2-year yield. And you can see that it actually flattened. And what does that mean? It means that the yields on the front end bonds, so the price went down more aggressively, pushing up the front end yields down more, whereas the long-term bonds, the price went down, but not as much. And so those yields didn't go up as much. So they therefore flattened the curve. And what is that saying in simple English? Is basically saying that even though the Fed might be a little bit more hawkish, which is technically bad for all bonds across all tenors and all durations, at the end of the day, if the Fed, which is being a responsible kind of like a doctor giving you a nasty medicine for, let's say, a fever, in this case, fighting inflation, ultimately, long-term bonds, which are more susceptible to the dangers of inflation, gnawing away at your sort of yield or sort of coupon sort of income, basically long-term bonds ultimately quite like the tough medicine, the tough love to combat inflation. And that's why they actually had a bit of a comeback and outperformed on the day the front end of the curve. So there were two good trades. You could have shorted the 2-year or maybe shorted the long end, but really shorting the 2-year and maybe doing the flattener trade. So the flattener trade is that you short the 2-year and at the same time, simultaneously, you buy the long end with the idea of outperformance. Now, what other asset classes are there? Of course, the other asset classes we could look at, for example, gold. Now, gold also sold off pretty aggressively, always in the 3-minute chart. And you see this big sell-off in gold here. Why would gold sell off aggressively? Because, first of all, one of the reasons gold has a sort of a risk premium, a trust premium, more trust in the Fed with someone who is not Hassett. Basically is a negative for gold because suddenly the risk premium disappears. So that's one reason to sell off gold. Secondly, gold does not bear interest. It does not pay interest. So if interest rates are potentially not going down, there's less reason net to hold gold and less inflation. Gold is also considered inflation hedge. So if the Fed is being a bit more aggressive or less overly dovish and fighting inflation, that is a negative for gold, which, as you can see, sold off aggressively. So another great trade, immediately just sell gold. Now, what are some of the other trades? Of course, you could also, if we look at the dollar, for example, you can see the dollar index. The dollar index went up very strongly. This is the Dixie. So you can see, though, if we look at a bunch of the different sort of currencies, you can see the euro went down against the dollar. You can see the Australian dollar went down against the dollar. You can see the US dollar went up against the yen. The New Zealand dollar also, and the US dollar went up strongly here. You can see against the Swiss franc and also against the Canadian dollar. So US dollar strength. Why? Number one, similar to gold, more trust in the sort of ecosystem, the Fed governance, the Federal Reserve System. But also, if the Fed is cutting less and not cutting in an unjustified way, that means interest rates will not be cut, and therefore, all things considered, bonds yields would rise, or at least would not be cut, which is a positive for the US dollar. And also, in a sense, more fiscal responsibility or just sort of, sort of monetary policy responsibility is net a positive for the US dollar. So a great trade is to go long the US dollar. Now, what about equities? Just to finish up here, what we also saw is that equities, and we'll go back here to the bonds, which I want to put up here. I can find the bonds. So one of the issues here as well is that equities are very sensitive to interest rates. Equities do not like higher interest rates. And so basically the fact that the bond is, for example, the 5-year futures, the same thing, the 5-year and the 10-year and the 30-year, when those bonds are selling off, pushing up the yields, that means higher interest rates or a less accommodative Fed. And generally, equities love liquidity and they love an accommodative monetary policy. And so the fact that all across the board, the bonds were selling off and the yields were rising. As you can see, this is not great for equities. And if we look at, let's say, the S&P 500, the same with the Nasdaq and the same with the Russell. But if we look at the S&P 500, you can also see how that sold off here pretty aggressively. You see here, there it's come back, but basically there's the trade. So that's the one example, a case study of how to trade. Understanding the macro, the context, and the different scenarios, seeing that a certain trigger triggers a certain scenario, understanding how the various asset classes will perform, and then you can just immediately place a trade, even in and out of the trade. In this case, 15, 20 minutes, maybe with the futures was a good linear way to do it. Or if you wanted to short something, you could, for example, buy long puts, just a simple long put on the S&P. You could buy you could sell FX, you could buy the US dollar against any one of these currencies on sort of spot FX, or indeed on the bonds, you could have just shorted the futures for all of the bonds and maybe even done a spread curve. So I hope that's useful, guys. Going forward, I'm going to try to do more of these sort of trading macro, relatively short videos where we look at a specific trigger, a specific incident, and just look at the way, the correct way to trade that sort of successfully with a quick in and out trades, often just 10 or 20 minutes in the trade. Thanks very much. Have a great rest of your day.